Hello, this is Mike Swanson. You're listening to the Wall Street Window podcast. I'm going to talk about the stock market, just me with you, in a few moments. But first, I want to tell you that Amazon is running a special this week for my book, The War State, on a countdown deal for the Kindle version for only 97 cents, almost practically free for that matter, which is less than $1. But the price goes up every couple hours till it goes back to full price. So go to Amazon.com, grab the book, just go to Amazon, type in The War State. And the subtitle of the book is The Cold War Origins of the Military-Industrial Complex and the Power League. That's what the book is about. It's about how the United States became a global empire after World War II and the two groups involved in that happening and had so much political influence and economic importance in today's day and age in our country. Now, last week I spoke with Carmine Savasano in a podcast. We talked about an article he put up on his website about the origins of violence. And Carmine's putting out a book, it's going to come out in February, titled Human Time Bomb. It's also available on pre-order on Amazon. It covers that topic among many others, kind of about the social conditions that we're now in and why things seem to be becoming so divided and so crazy. And his book does not include the name Donald Trump in it. It's a much deeper look into what is going on. But in the interview I did with him, we talked about the three things he postulates are big motivations for why people commit violence. And one of those things was fear. Now, before we did the interview, we were just talking, and he thought maybe I should talk about fear in the markets. Well, I'm going to do that with you in this podcast. But on tap this week, we got the Federal Reserve meeting on Wednesday. No one expects the Fed to lower rates again or raise rates again at this meeting. They're basically now on standby mode. But there's the next move, everyone knows, is going to be a cut at some point in the future, just a matter of when. But no one expects really much to come out of that meeting. Just a statement about how we're in a holding pattern. Really, the big event is going to, Fed meetings also bring often short-term gyrations in the market. So I would think if you're interested in buying stuff, whatever sector you're interested in, if there is a dip around that Fed meeting or what you like, that might be a time to do that. But on Friday, or this weekend, coming up, is going to be December the 15th. Actually, that's next Sunday. But that's the deadline weekend for Trump to put accelerated tariffs on China. Those were tariffs he announced months ago, way back in August. And then in October, at the beginning of that month, they had a kick the can down the deal agreement about those tariffs. Trump said we will negotiate until December, and here we are coming up. So there's been no signs of any trade deal, and reading the different sources both in Asia and in the United States this weekend, there's no sign of one coming. So I guess the question is, will the tariffs hit, or will there be another let's pause and kick the can down the road? But this is going to be a key week, really, that's going to set up the whole situation going forward. Basically, this is it. Pause now. There's probably going to be pause through the election, and if not, then there's going to be more tariffs and more trade tensions going forward. I'm not going to predict which way things are going to go, but the consensus in the media seems to be that there is going to be let's just kick the can down the road, and Trump won't do those tariffs and the promise of more rounds of negotiations, which would be consistent with basically what happened in October. But this is going to be an interesting week, towards the end of the week, to see what happens there. As far as fear goes, though, in markets, a lot of people think that whatever the market is they follow, whether it's the stock market or Bitcoin or the precious metals markets or whatever it is, that they like this market, they invest in the market, they trade it, and then when it goes down, they typically think that it's being caused by fear because people in the market suddenly are being irrational in selling when they shouldn't be, because the people that are investing think they shouldn't be selling, so they say they're scared, they're fearful, and so forth. The point is that there's a popular notion that stocks fall because of fear. And I want to dispel that idea with you. Fear does not really cause corrections in the stock market, or bear markets for that matter, either. It's simply natural for stocks to pull back, for dips to happen in a bull market. Many times in a bull market, a market will hit the 150 or 200-day moving averages. Things just simply cannot go up every single day. So, it's just the way things go. As an ebb and flow, and that process in a bull market really is not caused by fear. Short-term dips aren't really fear. They don't start on fear. Where fear comes into selling, though, is when there is a decline in a market that's big enough that it actually causes the people in it to feel enough pain that they sell out. They get scared of further losses. And that can bring in a capitulation bottom. It often causes the VIX to spike up beyond 30, sometimes over 40. That's what happened on the bottom last year in December in the U.S. stock market. But that stock market decline last year, it ended in panic, it ended in fear, but it did not start with those. And that's the point I'm really trying to make, is corrections and bear markets are not triggered by fear. Short bottoms and selling climaxes are associated with fear, no doubt about that. Look, if you're on full margin and you see your account go down 30%, you're going to get scared. But if you're fully invested in stocks or even a margin and your account goes down 1%, you're not scared. What drives people's psychology in the markets is not a news item that they read one night and then get scared and sell everything the next day. It's simple price action. Price action is what drives perceptions. It's what drives the psychology of investors. And this is true now more today than ever before, because the stock market has not really had bear market. It hasn't had a bear market now in almost 10 years, and it's just also the way people are investing. They're not, for the most part, the average investor is using exchange traded funds. They're not even thinking about the stocks in the funds. They don't think about valuations. They don't think about earnings. They just think about, I got all my money in this ETF or this fund, and as long as it's going up, that's great. So a 1 or 2% dip or 5% or even 10 in someone's account, generally speaking, is not going to cause most people to get scared. But once you can see a 20% decline an account, then people start to get scared, and that turns into panic for some. And that's why often corrections end with 20% declines, because panic and mass fear is what creates a selling climax and a bottom. So this is the point. People's psychology in the markets is driven by price action and their own account balance. And that's really what's going on. It's not all of a sudden someone wakes up and gets scared, or someday some guy wakes up and just gets super greedy. That's really not what happens. In fact, I'm going to argue that this time of year, where fear comes into the equation in the markets, is not in causing people to sell, but in causing people to buy. Because when you reach the end of the year, you have mutual fund managers, hedge fund managers, money managers, and so forth, who can be lagging the market. In fact, most of them do lag the market. And when they do that, they only got a couple weeks to play catch up. So they become desperate to make trades, to try to attempt to do that. And then if the market itself is going up in the final weeks of the year, then they have to, if they're in cash or don't own enough, then they end up having to buy, because what's going on is they're looking at performance, they're suffering from performance anxiety, and then they see the stock market going up, and now they become fearful that their performance problems are going to grow. So that fear does not drive them to sell, it drives them to buy. And that's what really creates major tops in a market, or at least the short-term end of a rally. Buying climaxes driven by fear. So those who assert that tops are created by causing people to get scared and then they start to sell are absolutely wrong. Where fear comes into the equation is causing panic buying at a top. And when everyone in a market who has money buys, then no one is left to buy, and the buying is exhausted, and the top is put in. So this is how the psychology really is driven. I say this because how many times have I seen a stock market go down a day, and people just will say, "Oh, people are just being scared. They shouldn't be scared." That's not how things really work in the markets. So we go into the end of the year. Stock market's up for the year. Most sectors are up for the year. A few exceptions, and maybe that's something to talk about later, and what will happen to those exceptions, like the marijuana stocks, the dope stocks. What's going to happen to them when they have crashed like multiple times this year? They crashed in August, they crashed in October, and then they crash again. Will they stop crashing? That's something we will talk about sometime. But anyway, that's where we're at, and we're heading into the end of the year. So the best sectors are going to be ones that people buy, because these same money managers want to show, hey, I'm smart, I own the best things. When New Year comes around and people start looking at the fund's holdings, they put out their annual reports. So a lot of December action is driven by chasing the things that have gone up the most, selling the things that have done the worst, because you don't want to show them on your books, or you want to take tax loss selling on them if you're a regular investor, which is a smart thing to do, and then just buy them back in January, or buy something better for that matter. So interesting time. This is a week. Let's see what happens on the Fed meeting. Let's see what happens with the trade situation. But personally, I don't feel like trading ahead of the trade stuff. So I'm pretty content to just sit and watch what happens this week, and then set up some trades for the rest of the year once this week is over with. Because the news flow is pretty much going to be done after this coming weekend, and then you can basically just trade the charts, setups that you like, and not have to worry about some surprise news. Any surprises are coming at the end of this week or next weekend. After that, it's all going to be the chart situation, how it sets up will likely define the final couple weeks of this year. So that's my thoughts as we go into this week. And again, remember, Amazon.com running a special for my book, The War State. Go there now, go to Amazon.com, type The War State in there in the search box, grab it, and I'll talk with you later.